So here today with us in the studio we have Ryan Martin, Site Inspector and Business Development Manager for BMT Tax Depreciation. Welcome, Ryan.
Thank you for having me.
So I guess you should tell us a little bit about yourself first. How did you get into this?
I've been working for BMT for just over 2 years now. Have always had a passion for property, wasn't too keen on working weekends and saw this as the perfect solution. Also had a good friend who was in the industry and he actually introduced me to BMT.
Okay, first thing I suppose we should know is what is depreciation? What does it actually mean?
Well, depreciation is a tax deduction. It's effectively a way of claiming the wear and tear on either the building or the fittings and fixtures within that building. So it's a way of reducing the person's taxable income.
And is this applicable to any properties? I'm thinking of older properties. Is it still relevant for that?
Yeah, absolutely. Depending on the age of the original dwelling, we can either claim the building itself and the fittings and fixtures within it, or if there's been significant renovations done to older properties, we can go in and assess those renovations. We'll do a council search. If there has been additions to that building, we can claim those. But in any property, we can claim the fittings and fixtures within the property.
And is that ongoing? So if I keep renovating each time, I should go back and have a look at my depreciation?
Yeah, absolutely. We won't necessarily have to go out to reassess the property. If you know the costings, your accountant can then add to that report. Unless it's significant renovations, and then it may be beneficial for us to go out.
So would accountants normally tell their clients about this? How does that fit with what you're doing?
Yeah, I guess there's a bit of a split. Some accountants are really up to speed with depreciation and the benefits of it. There are still some out there who aren't maybe totally educated on it because they need to know about every single thing within the tax laws, where we are experts in depreciation and maximising deductions for clients.
So what sort of benefits then can you get from tax depreciation then?
The benefits are effectively, it's a way of reducing the income tax. So what we do is we go out there, we assess the building, we can put a construction cost on the building and then an individual valuation on the fittings and fixtures within it. That amount then can be classed as a tax deduction, and when the client does a tax refund, that amount comes off their taxable income.
So how do you work out how long something should last? Like what sort of wear and tear? Is there standard figures for that?
Yeah, absolutely. The ATO have a guideline which we have to abide to. So they give all the different divisions, Division 43 being the building, Division 40 which is the plant and equipment. They all have their own effective life. So things like carpets have their own, hot water systems have their own, and we have to abide by those laws.
Because that's interesting from the rental market perspective, which obviously interests for me in the property management division, is because landlords think that they can keep carpets and painting. So what sort of average would there be for carpets before you have to upgrade?
Well, there's no, I guess, rule of thumb as such. The carpets have an effective life, so that determines our calculation. So we give it a value to start with, and then over that, say, 15-year period, that the deductions are claimed from that amount. So there's no, I guess, one figure for when they should be replaced, but I guess our calculations are based on the effective life of it.
Right. And how long do the reports last for once you get them done? Yeah,
our reports will last for 40 years. So it's generally a once-off report. Unless there are major renovations done, as I mentioned earlier, then it could be beneficial for us to go back out. But generally, one report will be sufficient for the owner.
And is it applicable to any type of properties? What about units and townhouses?
Yeah, absolutely, absolutely. As long as it's income producing property or it's available for rent, so whether it's commercial or residential, whether it's student accommodation or a holiday home, you can claim the depreciation, whether it's the building, depending on the age, and the fittings and fixtures within it, so absolutely.
And what do you actually put in the reports? Do I then send that to my accountant and then he sorts it out, or what information is in there?
All our reports are taken care of for the accountants, so it's a really easy, quick fix for the accountants. They don't have to go through and decipher the reports. All the information's readily available for them in an easy format which they can read, and obviously if they need to do any adjustments over the years, it's quite easily available for that to happen. So it's quite an easy option. Generally most clients will just give their reports to their accountants.
Along with the shoebox.
Yeah, absolutely, because it's approximately a 34-page document, which can be a bit of information overload for some people, but accountants, who are up to speed can certainly go through it and pick it out quite easily.
And have a look. And so when you're looking at these types of reports, so if I'm just a layperson having a look at that, is it easy to read, even though I know it's set up for an accountant, but if I get it, am I going to go, what's this all about?
I guess it's as easy as you want it to be. You can delve in and look at a lot of information, but most people just want to know how much each
That's what I was going to say, bottom line.
Absolutely, each financial year, how much I can claim. We give a 40-year projection, and it has, for each financial year, a dollar figure. So all the other bits and pieces within the pages are good for accountants, but probably information overload for clients.
So if I have a standard 3-bedroom home, what sort of, it's mid-range age, maybe 15, 20 years old, what sort of amounts could I be claiming?
There are a lot of variables that take place in that, obviously depending on what types of fittings and fixtures are within it, the type of building. But I guess I'd say if you bought a property sort of now, a new property now, around the $320,000 mark, either north or south of Adelaide, you're looking between probably $8,000 to $10,000 in tax savings from depreciation in the first full financial year.
Right.
So it can be significant.
And then how do you project that out for 40 years then?
So pretty much what we do is we calculate the building side of things. So we'll go in there and do a construction cost of the building. So things like the bricks, the mortar, the driveway, the fencing, etc. And we'll put a value on that. The client can claim 2.5% of that amount over a 40-year period.
There's a lot involved in that. Sounds like a great service. And I said, I know from some of our landlords, a lot of them aren't aware of it, so it was really good. We'll come back to Ryan later, but for now, we're going to have a look at Going Gone.